Investors have a number of flaws in evaluating, impacted by a sense of success because of a recently good trade or something they've held for a long time. And they just simply say, I'm getting good at this. I can repeat this. And it's a big mistake. My name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
There's a lot of behavioral research done by academics about investor behavior and what we do wrong. Most of all, it's a function of being overconfident because we have done something that turns out okay, not because we did it right, but the outcome satisfied us.
Correct. Happens all the time, especially in investing, and we've got such, like you said, Don, the recency bias is what really sinks the ship so many times. That and just flat ignoring what actually goes on. If you can just forget about every bad trade you'd ever made and don't put any of those into your analysis of, hey, how am I doing? Your results are going to look way better than they actually are.
Well, the recency bias can also come from just simply having taken a course or listening to, following a guru,
Sure.
And getting a good trade out of there. Anything's just happened, and maybe this year or at least over the course of the last year, you say, that was a winning trade. Look how much money I made. If I just did that full time, I wouldn't have to work.
There we go.
Have you ever thought that?
Yeah.
That's a common rationalization for why I should be in the market and why I should do things the way I'm doing. But the bottom line is also proven academically is that those positive outcomes are generally not repeatable unless there's actually a process, a disciplined process that is repeatable, and you follow the process. When your outcome is good and you can say, I did A, I did B, I did C, and I did D, and I sold and it was a profitable trade. That's good. But if you say, no, I just read this article or I heard this on the radio on my way home from work and I decided to place a trade tonight for tomorrow morning, that's not repeatable.
Correct. Correct. But many investors think it is. If as long as the outcome was good. If the outcome was good, then it's like, well, I should, like you said, I should do that again. That was great. I should do that again. Not looking at the fact that, you know what, that was a pretty high risk move. That's why the return was high. And most of the time, it's not going to turn out that way. But I'm not going to think about that. I'm going to think about, I just did it. It did well. And therefore, the risk really isn't that bad. I'm going to do that again. And that's when you get bit. That's when the probability of what you're doing catches up with you. And it doesn't matter how good the last outcome was. The outcome's not the end all. It's what was the process to get you there. And like you said, Don, do we have a repeatable process in place that will let us stay on the probability side of being successful? Just probable. Nothing works all the time. And just because something high risk works out one time doesn't mean it's going to the next time.
So part of the issue of being disciplined is being able to recognize that perhaps you just bought a mistake. The question is, how long will you hold that? And if you have a set of rules and the discipline to follow the rules, you're going to know when to sell, even though it's not working. It doesn't have a good outcome, but you don't want it to turn into a disastrous outcome, which if you bought it on a hunch or on a tip and it's not working, how do you know that the tip was bad?
Yep.
You don't until it's really bad. And then you're saying, well, I don't want to do that again. Well, how did you get there? You got it because you were listening to somebody on social media say this particular stock is going to IPO or just IPO'd and it's going to go to the moon.
Right.
This is a rocket ship waiting to take off. And like one of Elon's recent launch attempts into space, it blew up on the way. And so yours blows up. And that's a mistake. But you don't know it's a mistake until it's way too late. You turn around and you buy something and you have some rules and you have a stop loss. You either get taken out automatically or you're following it with a disciplined review process and you will take it out yourself. You will place the sell order and say, okay, so I lost 0.5%. Matter of fact, I did that today on one of the trades we have in a portfolio.
There you
It
go.
just simply has moved sideways instead of continuing its upward move. And there are many other positions that are doing well instead of hanging on to something hoping that it will turn out better. So 0.5% loss is not a big deal when I could be and am making double digit returns in other assets, and I can go find something else. But that's a process of rules, not hunch.
That's it. And that's why it's repeatable. And that is real risk management. That really is looking at a portfolio honestly and saying, hey, this part's not working. Let's not just hang on to this and hope it turns around. We say it all the time. Hope is not a strategy. That is not something that your portfolio should be filled with. You need to track the data. And when things are moving against you, make a move. Don't just follow it down. That's the people get married to their stock and they say to themselves, well, no, I spent a lot of time making this decision. It's a great decision. It's like, no, if it's losing money, it wasn't. And that doesn't mean you made a mistake. It means it's moving against you. Don't just write it down. Make sure you get out of the way. And by the way, position size. That's another huge element of controlling your risk. If you have something that was very successful, that doesn't mean you put every penny you have into something similar the next time around. That's bad risk. That's bad risk management. Never make a bet so big that if it moves against you, it wipes out your portfolio. That's too much risk. That's something that's within everyone's control. We can control that. We can't control if that the security we just bought is going down. We can get out of the way when that happens. But we don't want to make sure that there wasn't so much of our portfolio exposed to one position that if it starts to back up, that's going to sink everything we've been trying to do for decades. And you can do that to yourself by getting overexposed, getting too concentrated, and feeling too confident that, oh no, this is going to be great. Especially if it's because so and so said so. That's the worst reason to make a big move with your portfolio.
The concentration actually can work and does work in your favor as long as you understand what you're doing and how you are getting there. When
Yep.
you turn around and take a look at the 11 sectors that make up the S&P 500, there's only 3 or 4 at any given time that you should be invested in because they show dominant leadership. They are the dominant areas that are attracting investor capital, and investor capital inflow drives prices higher. If you're buying sectors
Right.
where investors are not interested in what you think they should be, the prices aren't going to go up. Well, why are you putting your money at risk in the market in areas where the rest of the world disagrees with you because they're buying some other sector? Well, you can be broadly diversified, but that's to your detriment most of the time. As Warren Buffett has said in the past, diversification is for people who don't know what they're doing. And
Sure.
most of the time, if you're using a financial advisor, they are diversifying you, which should be a warning for you. If you have an advisor who's saying you should have so much in your bonds in your portfolio because that's risk management, owning an asset class that's falling for 5 years in a row. That's not risk management. That's academic stupidity. It's ignorance of how markets actually work. Markets work by rotation, where there's opportunity and money is treated well, money flows there. And those areas grow. And those are what should be in your portfolio, not just a whole bunch of stuff so you can say, I own the whole market. Well, big deal, but that's
Right.
probably not going to accomplish your financial goals. The other area of concentration that's a detriment is you own a winner and you don't take your profit out. At some
Sure.
point in time, what you just pointed out a minute ago, Perry, is that position can become overly concentrated in your portfolio and thereby increase your overall risk beyond what you originally intended your total risk to be, your risk exposure to be. So one of the disciplines of risk management with a winning position is incrementally reducing the money that's in there, taking some capital gain, putting the money back in cash or finding another position that is working, but you've reduced that risk of a single winner having a piece of bad news, whether that's litigation, a CEO problem, financial disclosure. We have no idea what the problems are that can pop up that cause a position to collapse anywhere from 10 to 30% overnight.
There's
And if you
a long list of things that can affect, especially if you're owning an individual stock. And you know, we're not saying equities is that means don't invest in equities. You should. You need to be invested in equities. That's where the returns are. But you need to make sure that you're not living in a fantasy land that says, well, this has been a great investment, let's say for a whole year. There's no reason to ever sell this. I'm just going to hang on to this forever. That's never true. The winners always rotate, and you're going to have to move with them. Otherwise, all your gain's going to disappear and you're going to write it straight back down again. And so you need to be aware all the time that, hey, that was really good, but it's really starting to deteriorate. Time to move on and sell that out, bank some cash, and move on to the next thing. Never be afraid to say that this looks like it's run its course. You don't have to be in too big a hurry. You don't have to try to hurry and get out all the time. But when clearly something has peaked and is everything's beginning to affect the value of that security, headlines, opinions, and the cash flow is beginning to move somewhere else, don't be afraid to leave. It's time to go. You're going to find something else. There's a lot of things out there, and the key is own the winners and cut the laggards out of your portfolio as quickly as you can.
You'll find that's gives you a sense of peace and it allows you to handle the volatility in the market.
Sure.
Because you're just consistently reaping smaller and smaller portions of a winning position. But on the other side, when you start small because you're doing risk management, you don't want to overexpose your portfolio on a new trade. You turn around with something that's working, you can systematically add to it as long as the trend is up.
There you go.
Once that reverses, you just start unwinding it systematically and redeploy the capital. You can be diversified, but you should be diversified in winners, in leading positions, strength in the market, not diversified for diversification's sake. That actually is self-defeating process. And that's what most financial advice is based on, is modern portfolio theory.
Sure.
Modern, if you consider 1952 to be modern. There's been a lot of research that's been done since then, but you'll find successful managers do not follow modern portfolio theory in their own firms. They do that for retail clients because it reduces the amount of litigation that they otherwise would be exposed to.
And that's the important part. It's for the advisor, not for the client. And that's why they're handing out that pie chart. That helps protect them. It doesn't get you the portfolio that you need to meet your goals. That's going to take some sector rotation. That's going to take making moves based on what's going on in the market currently, not what went on the market 50 years ago, and that long-term average, which distills that move down to information that becomes not important. It doesn't matter what the average was over the last 50 years. What's happening today? Markets are dynamic, they change quickly, and you need to be able to react to that, or the market will roll right over you.
Well, 50 years ago, the energy sector, oil companies dominated the S&P 500. They were the biggest asset class at the time. Today, energy is the smallest asset class in the S&P 500, and technology is the largest. That's a systematic change as the economy has developed and information has developed. So we know more, we do it more efficiently. Business can do it more profitably. And your portfolio should reflect those changes more so if you are paying attention than if you're relying upon an index to do that, which has other problems associated with it, which we cover in another podcast. So if you want to talk to us about your portfolio and how we would look at it from a concentration and risk management standpoint, you give us a call. contact information's on the screen. Subscribe to our podcast. Thanks for being with us, and stay tuned because we have more coming.